Hello, I'm here with Bill Lazonik, who is the president of the Academic Industry Research Center. Bill, thanks for being with me this morning. I thought we could start just by chatting about a presentation you made recently at the Ford Foundation, because I think you've challenged a lot of the prevailing, shall we say, Reaganite myths that we have about shareholder value and our American style of capitalism and how successful it's allegedly been.
Yeah. Well, yeah, the project to which you're referring is called the Financial Institutions for Innovation Development. It looks historically, comparatively, at actually how rich nations get rich and how developing nations get to be there as well. Of course, a lot of interest now on China, as there has been for some time. And it's related to some INET grants I've had on, the one's called the Stock Market and Innovative Enterprise, the other one's called Impatient Capital and High-Tech Industries, focused mainly on the U.S. Now, the key argument that is being made is that when companies invest in ways, and we have to look at the company level, the state is important, but we have to look at the company level, when they invest in ways that lead to prosperity, lead to good jobs, lead to a somewhat more equitable distribution of income than we have now. Basically, they invest in people, and they invest in knowledge, and they invest in the future, and they invest in building good products and good processes. And profits are an outcome of that process.
So profits are an outcome of that. The other thing I wanted to mention, as you say, you focus on the company level, but I think historically, I think it's fair to say when we look at economic development, even in the US, that the state has played a very important role. I mean, down from the days of Alexander Hamilton and his nation building the Erie Canal, Eisenhower and the highway system. And yet somehow over the last 25, 30 years, that whole idea of government as collaborative partner has gone out the window. It's now viewed as a hindrance, as something that should get out of the way. Market fundamentalism seems to be...
Well, that's the official rhetoric.
Yes.
But the reality is, even now, business is lobbying for government to spend more on technology. There's this new BAM, or Brain Initiative, that Obama is pushing in the United States.
Yes, he announced that yesterday.
And there's lots and lots of spending by the government on technology. And it used to be much more something that the business would say, okay, you're doing that, and we're doing it as well. We have our research labs. We are investing for the future now. Now business expects government and taxpayers, as a result, to do all of that stuff and then get the benefits. And so that hasn't changed. In fact, if anything, in many areas that's increased over time. But over the last 30 years or so, you've had changes in the way businesses allocate resources, the objectives that they put forward, and as a result, the outcomes that are good for the bottom line, but are not good for the American people.
And the outcomes tend to be measured now much more on a quarter-by-quarter basis. They're much more short-term in orientation, and the prevailing justification is, we've talked about this before, shareholder value. This is what the shareholder wants.
So there are a whole number of changes that came in the 1970s and 1980s, and take a long time to recount all those. But one of the things that wasn't there at the beginning of the 1980s in the United States, in corporate boardrooms and business schools and general discourse, and one thing that was really totally embedded by the end of the 80s was this notion of maximizing shareholder value. So it was really a new ideology for corporate governance. And there were a lot of influences that led to this, but basically what it argued was that, and it argues, since it still dominates, is that the only group of people, the only economic actors in the economy who really take risk are shareholders. They don't get a guaranteed return. Common shareholders, you don't necessarily get dividends, higher
unless, of course, they invest in a bank, for example.
Yeah. But this is basically the general argument, compared with taxpayers, who are seen in this ideology, which comes out of neoclassical economics, as they don't have anything to do with it because they don't have any theory of what you talked about before, of the government developing for, technology, investing for the future. And workers who are just paid a wage, and suppliers are just paid for their input. So you just have something left over. It's not really explained, which is profits. Like, we call it residual because what's left over. And then shareholders have the right to figure out how to reallocate that because they're the ones taking the risk.
And as you say, it's interesting because the idea of labor as an input, I mean, when you have that idea of labor, of course, it justifies this whole strategy where you keep cutting wages and benefits across the board.
So labor is just a commodity, it's dispensable. Okay, now there's two fundamental things wrong with this. One is related to what you raised about the role of the government. The government is always, and taxpayers as a result, is always making investments in new technology, in infrastructure, without a guaranteed return. When the economy grows, the government and taxpayers may get that guaranteed return. And in fact, in the post-war 2 decades, that was kind of implemented through a very progressive tax structure. But that's not been the case for the last 30 years.
So no, in fact, we seem to be engaging in forms of tax arbitrage right now.
And so businesses and individuals who run business, corporations, as I really equate big business now, not so much with the business as a whole, but with the very powerful people at the top. They're saying, give us lower taxes. We can't do anything if you lower taxes, but we want the government to spend more. So that's the first problem. The second problem is that when you employ someone, you actually, over time, want to pay them higher wages. You want them to be more skilled. You want them to be more productive. You want them to work together in teams. And if you ask, well, even today, most corporate executives, what are your most valuable assets? They'll say, our workers. And you say, well, how come they're not on the balance sheet? Well, because they can walk out the door. We can't own these people. We don't have slavery, but we want productive workers. And if you ask them further, okay, if someone comes to work, do you want them to just do what you tell them, or you want them to work extra hard? Do you want them to learn? Do you want them to exercise initiative? Oh, no, we want to exercise initiative. You know, that's what a good worker is. Now, you can hire some people for some jobs where you just want to pay them just for an input for the output, but that's not what makes for a prosperous economy.
Right.
So that's the other problem, that people, when they go to work every day, are making investments for the future with their time and effort without a guaranteed return. Sure, they're getting a salary now, but they're doing it to build careers, to build a future for themselves and their families. And it used to be that American corporations helped them do this and saw this not only as something that they did, but something that was good ultimately for the corporation in terms of the products it produced, the profits it could produce, and even for the share price. Since the early 1980s, the ideology has shifted quite profoundly. As I said, by the end of the 80s, it was already totally in place, that all that doesn't matter, even though corporate executives know it matters. So there's a big difference between the ideology of what the state does, ideology of what workers do, and what corporate executives argue. And the ideology, however, of maximizing shareholder value, it's just not kind of a benign ideology that's out there and that people are teaching in business schools and economists are repeating. It actually influenced corporate resource allocation behavior in a very profound way. And the phenomenon that I've focused on, which I think is a fundamental problem, is companies buying back their own stock, which really, again, was hardly existent before the early 1980s. It was part and parcel of the growth of the shareholder value movement and ideology under the notion of disgorging the free cash flow and just putting out their shareholders.
And it's worse than that in some respects. It's symptomatic of the increasing financialization of our economy.
Well, yeah.
And you seem to have this situation now where the excess cash doesn't go into investing in new productive equipment, factories, good jobs for the workers. In fact, it goes into buying back shares.
Buying back shares. Now, one of the things that I focus on, because lots of people have talked about financialization. It's a big topic. It's very important. But it's not simply what Wall Street's doing. Right. It's what's going on in the industrial heartland, in these industrial corporations that produce products for export, that need to train people, that need lots of skilled people. They might have them more now abroad than in the United States. That's where the problem is. My view is that if the leaders of industrial corporations were really saying, no, we really need to invest for the future, we can't just be focused on our stock price, then Wall Street would be held much more in rein. in fact, wouldn't have been transformed to the extent that it has.
But even in these companies that as you say, they represent the industrial base of America.
Yeah.
I mean, even they become to some degree very financialized. I think, for
Oh, yeah,
example, of a
of course.
company like General Electric. I mean, General Electric derives almost 50% of its profits now from GE
Yeah,
Capital.
so it has both of these elements.
Yeah.
General Electric is the repository of some of the most important technologies that have developed not just in the United States, but in the world. And it goes back, of course, back to Edison, and back to formation of General Electric, 1892. So that's one side of it, and that's still extremely important to that company. But the other side of it is, GE Capital, which is not just a source of a lot of their profits, but in the financial crisis, a source of all their losses. So it combines both of these things. Now, but the thing is that it's the financialization shows up in corporations saying, okay, we have a lot of money available, we're profitable, let's just get our stock price up. That's the most important thing we can do. Now, this is not a minor phenomenon. For the last decade, for the, let's say, Fortune 500 companies or S&P 500 companies, it's been on the order of about $3 trillion of their profits just gone out there into the ether, in a sense, to raise stock prices. It has really no lasting effect. It's just a manipulation of the market, and it's going on. The pace is about $400 billion a year. It could go up. The peak was 2007, before the financial crisis. $600 billion for these 500 companies that are at the heart of the economy. So this is big stuff. This is far bigger than dividends, and dividends have gone up as well. But that at least pays people for holding on to the stock. The stock buybacks pay them for selling the stock. These things together mean that, say, the data I have for 2001, 2010 for the S&P 500 companies, 94% of their profits went to either buybacks or dividends, with 54% going to buybacks, 40% dividends. So you have 6% left over. That is kind of the seed corn for the future.
And then, of course, you have this, and you painted it. It's not a pretty picture, to be clear, but you painted it in somewhat generous terms, and by that I mean that you've excluded, I think, one of the most important elements, probably because you're being polite, but which is namely the area of accounting fraud, which Bill Black, for example, has spoken a lot about. But clearly, when your compensation structure is based on what your share price does, and not so much on what the underlying profits are, there's a tremendous incentive to, as you say, not only manipulate the share price, but manipulate the profits which drive the share price.
Okay, and this is, I guess, one of Bill Black's points is that not all fraud is illegal.
Yeah.
In fact, most fraud is legal.
Yeah. And
one of the things you find about the phenomenon of stock buybacks is that basically since 1982, the Securities and Exchange Commission has legitimized this fraud or this manipulation. It's on the books of the SEC that large-scale buybacks by companies, established companies, is a manipulation of the market, or can be viewed that way. But in 1982, the SEC gave companies a safe harbor for doing large-scale buybacks that is still in place. And so they can do them on the order of $200 million a day, $300 million a day, day after day, to just figure out how they can get their stock price up, to meet quarterly earnings per share targets, to get that boost if they've had bad news, to keep up with competitors. And the other thing you mentioned is among the biggest beneficiaries of this game are top executives whose stock-based pay is the single biggest component of their total pay, particularly gains from exercising stock options. And this is a wonderful way to maximize those gains
maximize quote-unquote shareholder value.
Yeah, shareholder value for the sake of top executives. And so there's a couple of things we know about that. We know that executive pay just keeps going up and up, even when the rest of the American economy is losing out, even when middle-class jobs disappear. They're related. They're related because the investments that those executives are making are in getting their stock price up, not in recreating middle-class jobs as technology changes, as there's new competition, et cetera. It's not that the world can stay still, but we rely on these corporations for the world to move ahead. And for the last 30 years, by and large, they haven't been doing this. So that, and I attributed this to this financialized corporate behavior and the incentives that have been created for people who control the allocation of resources to engage in this behavior.
And the disturbing thing, of course, is that increasingly this sort of behavior is not only becoming prevalent in the United States, but it's increasingly becoming a model in Europe. And one hopes, of course, that the Asians learn better, but even some of the Chinese officials that I spoke to seem to have picked up on this disease of financialization as well.
Yeah, well, this is another part of particularly these projects I'm running, is to look at what's going on in other countries. And although it's true that this ideology spread, particularly in the 90s, and when it was backed up by the internet boom coming out of the United States, mainly the microelectronics revolution, Silicon Valley, the new economy, everybody's saying we got to have some of that. I used to be on the faculty of INSEAD in France, and was in Europe a lot in the 90s, and well, I'm still in Europe a lot, but over the last 25 years, I've been spending a lot of time in Europe. And in the late 90s, everybody was just grabbing on. Even people, labor-oriented people, let's say in Germany, who believed in co-determination, said we got to maximize shareholder value. Fortunately, the internet boom turned to bust, and a lot of that argumentation disappeared in the early 2000s in places like Germany, Sweden, France, etc. So there's a much more balanced view in Europe now. Now Europe has other problems,
yeah,
but it's much less a problem, particularly in Germany and Sweden are the exemplars of this, where really they have anti-shareholder value ideologies in place now, in fact, implemented. You don't engage in this kind of financial behavior.
And hopefully that will actually start to redound back in the United States as well.
Well, if it's recognized, here's the way it comes back. Here's the way it comes back. First of all, you have to recognize the false underpinnings of the ideology that's pushing for these arguments in the United States. Secondly, you have to recognize what is actually determining shifting competitive advantage, whether it's in Germany, whether it's in Japan, whether it's in China. And in the case of China, China's so embedded with the U.S. economy through global value chains that there's a kind of an alarming amount of financialization going on there.
Yeah.
And I think that's just going to be the challenge for the Chinese.
And that's going to be something we'll be discussing quite a lot.
This needs to be brought under control by the Chinese. But there's a lot of the world that hasn't totally accepted this ideology, which is the good news.
And on that good note, I think we'll have to leave it here. But listen, I want to thank you very much for spending the time and sharing your insights with us.
Okay, thanks a lot.
Greatly appreciate it.